Hey guys, welcome back to the channel. Today we are going over a closed-end fund review. Now, I don't do very many of these because, to be frank, there aren't very many that are decent buys. And why I'm putting this one out is because it's probably one of the best closed-end funds that focus on utility companies, right? When we think of utility companies, we think of stable income producing companies. And with the current market volatility that we're in, could this be a time where you want to put some safe money, or you just want to allocate some money into income producing assets, right? Such as utilities. So we'll go ahead and take a look at it. I'm going to go through a bunch of stuff on this one. So stick around and to the end, and we'll talk about some dividends as well. And what's really important here, because this fund has gone through some volatility, and closed-end funds, even though this one, I should say in particular, is focused on utilities, it will experience some serious volatility. So if you're new here, please consider sharing, liking, subscribing, comment down below, do all that good stuff. Turn on that notification bell to be notified of any new content I come out with. All of you that have been using my Amazon link, I really appreciate it. It's down in the description below. If you use that, Amazon will send me a small commission on qualified purchases at no additional cost to you. I think that's the big thing. You don't have to do anything special to say thank you and send a reward. If you're normally shopping on Amazon, use that link, please. It's really simple to do, and I would really appreciate it. It really supports this channel and makes sure that we keep moving forward and growing. So thank you very much. So what ticker are we talking about today? Well, this closed-end fund I'm talking about today goes by the ticker symbol UTG, and it's the Reaves Utility Income. Now, normally I don't like buying closed-end funds at a premium to its NAV, or its net asset value, and I'll go over briefly what that means. I will be actually coming out with a very long video going over closed-end funds, and I'll timestamp it all that so you'll understand what it is. I'm basically going to be reading a book. But I'll try to explain it a little bit clearer as I know it, okay? But how a closed-end fund works is it issues shares at IPO, just like a brand new company, and that's all the shares it can get, okay? So it takes that money that it raised by its IPO, and it begins investing into the stock market. So what that does is it creates a separation. Since they can't create new shares, the shares on the market are manipulated by supply and demand. So not necessarily what the fund is invested in. So the fund takes the money, invests it, and then the investors bid on the share price, and that's where the fluctuation of the share price comes from. So what that can do is disconnect the share price from the actual value of the investments in the fund. I hope that makes sense. Because if you look right here, you'll see here the share price, the NAV, and the premium to discount. Now currently, UTG is selling for, well, this is probably recorded a few days early, but for $31.42. It's net asset value. So everything that the fund has that it's invested in is only worth $30.98. So you are paying essentially 1.42% more than what the investments of the fund are worth. Okay. So there are times where you can buy these funds or these assets that the fund has at a discount. And we'll look at the 52-week low, which happened probably, let me go to 1 year here, happened probably right around March or so, where the share price hit $19.45. But the net asset value of the fund at that point was $21.91. So you were able to pay $19.45 for $21.91 worth of assets. That would have netted you, or you would have gotten basically a 14.6% discount on the net asset value. So right now it's basically trading a little bit higher than it should, but I think with the volatility that we're experiencing, that maybe people are moving toward these income funds and utility funds, and probably parking some of their money in some of these income producing assets. So what is UTG? Well, we'll take a look at some of the investment objectives, and it's to provide a high level of after-tax income and total return consisting primarily of tax-advantaged dividend income and capital appreciation by investing at least 80% of its total assets in the securities of domestic and foreign companies involved to a significant extent in providing products, services, or equipment for the generation or distribution of electricity, gas, or water, telecommunication activities, municipal services, or infrastructure operations such as airports, toll roads, and municipal services. The remaining 20% of its assets may be invested in other securities, including stocks, debt obligations, and money market instruments, as well as certain derivative instruments in the utility industry or other industries. So when I talked about earlier about volatility, what I mean by that is that a lot of closed-end funds are leveraged. In other words, since they cannot produce more shares because it's closed-ended, they have to go and issue debt or take loans to boost the return of the fund. And this one has total debt of $445 million, which is effectively 22.5% of their portfolio. So what does that mean? That means that essentially if the market drops, it will drop not quite the amount of the leverage, but it will fall a lot further than if it weren't leveraged. Okay, because this is money that they don't own. If that makes sense. They don't really have ownership of it. It's borrowed money, margin, if you will. So again, closed-end funds, everybody gets turned off by the expense ratios. And obviously, these are actively managed mutual funds is what they are. So the management fees come out to roughly 1.17%, with the interest expense of 0.89, and that is on the $445 million debt. So a total interest expense of 2.06%. Now this is after distributions. That's usually how that works. All expense ratios are net expenses, or I should say all distributions are net expenses. So if you're looking at distributions or dividends, it's usually after you get paid the distribution after the expenses are paid. So So if we look, I want to go back to this chart, and what I wanted to show you is most closed-end funds do not have a chart that look like this. Okay, now we'll go to since inception, and that's a pretty decent looking, left to right upward, movement of the price, and that's usually not the case in closed-end funds. Okay, usually you'll have a dropping chart price in a closed-end fund, because a lot of closed-end funds, that's why I rarely put out closed-end funds when closed-end fund reviews, is because there's not a lot of good ones. There really isn't. And this one, though, is ran very well. And it's ran by these guys, Reaves Utility. And the vice president, chief investment officer, is Tim Porter. And the financial analyst that handles this is John P. Bartlett. And we'll go through a little bit of what they do. WH Reaves and Company is a investment management firm, and they've been an investment advisor specializing in utilities and energy infrastructure since 1961. They have approximately $2.7 billion in total assets under management, 40-year track record for institutional clients. Portfolio managers are supported by a highly experienced management team, and the research team averages over 20 years of industry experience. So this is part of what you pay for in the expense ratio, because these people aren't just buying an index and just investing the money. They're actively managing this portfolio. So their philosophy is information advantage can be created when experienced analysts focus their fundamental, quantitative, and qualitative bottom-up research within the utility sector. Furthermore, the identification of utility companies that are disciplined enough to supply growing dividend income to their shareholders is a key component in the management process. So what is their qualitative process? They want to management interviews. They want to gauge competence, track record, and alignment with shareholder interests, assess viability of management strategy, and judge likelihood of meeting goals, assess robustness of corporate governance. They'll do field research. I'm not going to go through all over this. I'll leave a link down below. They do field research, macro factor analysis. They do modeling and analysis, valuation, technicals, interview, review, internal review by team conducted weekly. So this is what you're paying when you buy a actively managed closed-end fund. It's not that they're ripping you off. They are literally doing the work, and that's where the value comes in some of these closed-end funds. Now, some of these closed-end funds just rip value apart, but this one has been a good performer, an excellent performer, actually. So we'll look at the dividends this puts out. Oh, I wanted to look at the top 10. Let's go back and look at the top 10 so you'll see what they're invested in. So NextEra Energy at 6.4%, Union Pacific Railroad at 5.6%, BCE, which is a telecom, I believe, at 5.2%, Verizon at 4.9%, Dominion Energy at 4.9%, WEC Energy at 4.7%, Fortis at 4.39%, TELUS at 4.14%, Eversource Energy at 4.1%, and Equinix at 3.94%. So majority is in the United States, some in Canada, some in UK and Italy, but mainly major utilities and major telecommunications and railroads. So solid companies and solid management. They have 44 holdings altogether, and if we look at their dividends, they pay currently a 6.87% dividend Works out to 18 cents per month. They do pay per month. And if we look at the growth rate that says 6 years, I don't know, Seeking Alpha has been throwing off some weird numbers because it's not true. If we look at the dividend growth rate, 10-year CAGR at 4.37%, and they've been growing their dividend since inception of 2004. Okay, so at 2004 they were paying $1.18, and now they're paying, what did we say? $2.16. So this is perfect. It's giving you dividend growth, some capital appreciation, and a little bit of safety. But that leverage could get you, and I'm going to show you why. This is where you become an investor, okay? In a closed-end fund, especially one that uses leverage. We're going to look here at what it did in the 2008 crash, okay? And this was a utility fund. And in 2000, from November 1st, 2007 to March 6th of 2009, you had a total return of negative 65.22%. So that starting price of the share went from $26.12 all the way down to $7.92. That is the effect of leverage, right? So the market was down 50 or whatever it was. I should have pulled that up, but the leverage will bring you down further than the market. That's the key. But as an income fund, this never cut its dividend. It may have slowed down its dividend growth through this period, but it never stopped paying its dividend. That is key. So if you were to reinvest this dividend into this time where it was trading at $7.92, you increased your dividend yield or yield on cost tremendously. So this was just a little blip, right? So let's look at the lifetime of this fund. And if we look at the lifetime of the fund, growth of 10,000, you have a total return of 398.83%, average annual total return of 10.22%. And that's investing $10,000 on March 2nd of 2004. Not a bad return. Now, if you took the dividends, you had a total return of 199.35%, average total return of 6.86%, but you got paid that dividend that whole way. And then just to show you how insignificant or how it looks, there's that 2008 crash, that little blip right there, that little red piece. So if you could have stood through that, you did very well. Now, on the dividends, here's how well this is done. And I haven't found a calculator that calculated this out, so I'm going to do this manually here. If you put in $10,000 in 2004, you collected $28.45 in dividends throughout that time. So at $10,000, we'll do that divided by the $20 share price. You had 500 shares. You bought 500 shares. So you collected $28.45 during that time. So we'll times that by $28.45. So over the period of, 16 years, you collected $14,225 in dividend income in your pocket, right? And your initial $10,000 is still gone up to $29,920. So not only have you pocketed $14,000, your initial $10,000 is now worth almost $30,000. This is the power of compounding. No, excuse me, this is not the power of compounding. This is the power of capital appreciation, or the quality of a closed-end fund to be able to grow its portfolio. Now, the big number here is if you reinvested that $10,000, you now would have $49,894. But you would have now, let's say you wanted to start collecting dividends from it. So look at that. Your starting shares was 500. Now you have 1,587 shares after 16 years from the initial $10,000. So you got $1,587, and it is now paying $2.16 a share per year. Now you are getting $3,427.92 a year in income. So that's $285.66 that will be paying you for, well, I won't say for the rest of your life because, things happen. But $285.66 off that initial $10,000 investment, and then you dividend reinvested. So, you'll get your $10,000 back in dividends in just a few years. Compounding interest. That's what we're talking about right there. So I know this went on long. One of my favorite utility funds. I don't have a position in it. I might one of these days. If I see it at a discount again, I'll probably jump on it. Let me know what your thoughts are. Do you invest in any utilities or any closed-end funds? Leave me a comment down below. Like, share, subscribe. Use that Amazon link down in the description. That would really help me out. You guys have a great rest of your week, and we'll talk to you later. Thanks. Bye-bye. I am not a financial advisor. The information contained in this video is for entertainment and informational purposes only. It is not intended to be investment advice. Please seek a licensed professional for any investment, tax, or legal advice. Thank you.